In the autumn of 2019, Margaret Hollis sat alone in her husband's study. Robert had been dead for 3 months. The brass clock on the walnut desk still ticked at 4:15, the hour he always closed the workshop. And on the desk beside it, a letter from their accountant. The estate tax bill on Hollis furniture came to $2.1 million. Margaret had never paid much attention to taxes. That was Robert's domain. But now she understood something brutal. The IRS doesn't grieve. It calculates. And the calculation said, sell the business your father-in-law built in 1961, or find $2.1 million you don't have. Here's what most people misunderstand about wealth. Earning it is only half the equation. The other half, the half nobody talks about at dinner parties, is keeping it. The U.S. estate tax exemption in 2019 sat at $11.4 million per individual. Sounds generous, but Hollis Furniture, with its real estate, equipment, inventory, and brand value, appraised at $14.8 million. That $3.4 million overage triggered a 40% federal tax rate. $2.1 million due within 9 months. Margaret's daughter suggested selling the workshop building. Her son wanted to liquidate inventory. Both options meant dismantling the very thing they were trying to save. That's when Margaret walked into David Chen's office on a Tuesday afternoon in November. David had been a tax strategist for 22 years. He didn't sell tricks. He sold time, specifically the compounding value of decisions made early. His first question to Margaret wasn't about her assets. It was about her timeline. Because tax strategy, David explained, isn't a transaction. It's architecture. You build it in layers over years, and each layer supports the next. The first layer David introduced was the Irrevocable Life Insurance Trust, an ILIT. Margaret would purchase a life insurance policy, but instead of owning it herself, the trust would own it. That single distinction meant the death benefit, $1.5 million, would fall outside her taxable estate entirely. The IRS couldn't touch it because technically, Margaret didn't own it. The second layer involved valuation discounts. Hollis Furniture operated as a family LLC. David restructured Margaret's ownership into minority, non-controlling shares, then gifted those shares to her children over time. Because a minority stake in a private company is worth less on the open market, you can't exactly sell 30% of a furniture shop on the stock exchange. The IRS allows discounts of 25 to 40% on those transfers. A share worth $1 million on paper might transfer at $600,000 for tax purposes. Legal, documented, exposed to audit, yes, but defensible with proper appraisals. The third layer was the simplest and most overlooked. The annual gift tax exclusion. In 2019, Margaret could gift $15,000 per person, per year, completely tax-free. With 2 children and 3 grandchildren, that meant $75,000 per year, leaving her estate with 0 tax consequence. Over 5 years, $375,000 vanished from the IRS's calculation. None of these strategies were exotic. None were aggressive. They lived in plain sight inside the Internal Revenue Code, available to anyone willing to plan more than 9 months ahead. By 2024, Margaret's taxable estate had dropped from $14.8 million to approximately $7.2 million, well below the exemption threshold. The estate tax bill went from $2.1 million to functionally 0. She saved the workshop. She saved the inventory. She saved 60 years of craft. Today, Margaret's daughter sits at the walnut desk in that same study. The brass clock still reads 4:15. The leather binder that was empty 5 years ago is full now. Every page a decision, every decision a layer. Margaret didn't become wealthy by accident, and she didn't preserve that wealth by luck. She preserved it because she learned the one lesson Robert never taught her. Wealth isn't what you earn, it's what you keep.